The Standard Deviation Channel indicator is an extremely powerful tool for helping us select stocks to trade and also for considering when to enter and exit trades. Best of all, it's simple and straightforward to use. It's an essential tool for many traders, especially option traders, swing traders, and even mid to long-term investors. In this video, we'll focus mostly on option sellers. However, the ideas presented will also apply to other types of traders and investors. So in this video, I'll explain in detail how to use and set up the Standard Deviation Channel indicator on your trading charts. I'll also go into the specifics of standard deviation theory and how it can be the most useful weapon of your technical analysis chart setup. Before going forward, please understand that this video is made for entertainment purposes only, and none of what I'm about to say in this video constitutes any financial advice. This is my own opinion about a commonly used trading indicator, and I urge you to research it yourself before you use it for any of your financial decisions. So here's a quick look at the indicator in TradingView. Other charting and broker platforms have it too. More on that later. As you can see, it creates a visual channel where you can track the past performance of a stock's price. The center line plots the average price of the stock over the period of time set in the indicator. So in my case, 6 months. And the upper and lower bands act as containers for 95% of the stock's price movement. Therefore, when you see the price moving above or below these outer lines, it is trading in an area only reached around 2.5% of the time. Next, the inner two lines create a zone where the price has moved within for 68% of the time. It's the area where the stock price likes to hang out most of the time. This visual data is super helpful in helping us make our trading decisions. Firstly, we can use it for stock selection. For example, if you've used a screener to create a long list of stocks, we can weed out a lot of the results that do not adhere to our standard deviation boundaries, giving us a smaller watch list of potential stocks to trade from. Also, we can use the indicator to decide the exact entry point of a trade, and for option traders, the point where we can set our strike price. Finally, we can keep an eye on our active trades and see where good exit points present themselves to close these trades. This can be either selling a stock or, for option traders, buying or selling to close the trade. Let's start with a quick look at the theory of standard deviation. Look at this chart. It's a visual representation of how standard deviation works. Now, standard deviation means that over a specific period of time, a day, a week, a month, whatever, the price of a stock tends to move within a specific channel 68% of the time. So let's say we were looking at a $20 stock and it moves either up or down $5 to $25 up or $15 down. That move happens at one standard deviation point, which means that 68% of the time the price of that stock is going to be between $15 and $25. A 2 standard deviation move means that approximately 95% of the time the stock will trade between $10 and $30. Therefore, we can see that there is only an approximate 14% chance of this stock trading between the 1 or the -1 and the 2 and the -2 standard deviations. Looking further out, there's only an approximately 2% chance of the stock going below the -2 standard deviation or the +2 deviation. Let's look at it this way. Say we set our standard deviation time frame at 6 months, which is our default setting on our TradingView indicator. If this stock is currently trading at $10, it has only been at or below that price 2% of the time in the past 6 months. So it's very little time below it. Therefore, we can safely say that during the past 6 months, the majority of the time the stock has been trading above $10, which is 98% of the time. Being at such a low level suggests that the price will right itself and start moving back to the 0 standard deviation, which is the average price of the stock over the past 6 months. It's like a rubber band on a stick. The more you pull it back from the stick, the more it will stretch and want to snap back to the stick. The same is often true with stocks. pulling further and further away from the mean average puts pressure on the price to return to its midpoint price level. Okay, let's be realistic. Stocks don't always follow this snapping back pattern. However, by choosing large, stable companies with stock moving in an upwards direction, we're putting the odds more and more in our favour. If they've been beaten down to an unusually low stock price level for little or no reason, it stands to reason that the price should, at some point, move back up to the norm. Okay, so where should we be looking at underlying stock prices and strike prices in relation to standard deviation? We want to look at stocks with a current underlying price near to or below the 0 standard deviation point. We don't want to select stocks that are trading well above 0 standard deviation, as that means it's been trading well above its recent range. With the rubber band analogy, it will have more chance of snapping downwards. Then, for the strike price, in the majority of cases, we want to select a strike price at around minus 1.3 standard deviation or lower. The lower the standard deviation is to the current underlying price, the lower the standard deviation for the strike price we'll choose. Let's look at some examples. Okay, so I've got a chart open here and I've turned on the standard deviation, which you can see there's the indicator turned on there. And this is for SLB. Okay, so you can see we've got the channels for the standard deviation there on the screen and the lines. Now each line is one of the standard deviation points. So this middle line here in the middle is the 0 standard deviation. So as it's a 6-month time frame, which I'll just quickly show you, 128 days, trading days, 6 months, the 0 standard deviation line will be the average price over that time period. Then we've got the plus 1 here and the minus 1 here. So you can see with the colors there shaded in where the 1 and minus 1 are. So that would mean that the price between the minus 1 and the plus 1 standard deviation will be trading within 6 months 68% of the time. And then you could say it's 34 and 34 within each of those. Then on the outside lines, we've got the plus 2 and the minus 2 standard deviations. So that would mean for one of those, there's a 14% of the time it'll be trading in that area. So you can see out of the 6 months, we've got some there and a little bit there. So that totals up. Outside of the 2 plus 2 and minus standard 2 deviation lines, we've got just a little bit there and a little bit there because it represents 2% of the trading time. And also well worth noting is the standard deviation. It looks like a channel, doesn't it, going up there. And you'll notice that this, particularly this stock, does seem to trade nicely within the channel. And we'll often see that with stocks. You'll have the standard deviation channel indicator on screen, and you'll see the stocks bouncing off either the 1 plus 1 minus 1 or the plus 2 minus 2 indicators, which again gives us a really good visual representation of what the stock is doing and how it's trending. Okay, so for this chart, let's look at the price, the current price, and also the price that we could select as a strike price. So you can see the stock here is trending just above the 0 standard deviation line. And we want to be around here somewhere, which is quite good. And then we're looking at setting a strike price around the 1.3 area down here. So we could set a price around this level, and that would give us this much of a buffer if the stock price falls. And also not forgetting if it does fall below, there's also a chance, as you can see here, it's very rare to trade outside of the plus 2 standard deviation line, a chance that it will come back up and back over our strike. Let's look at another one. Okay, this one wouldn't be a great candidate because it's so far up here from where we'd want to be setting the strike price. We'd lose a lot of premium like that. This one's a bit high. Okay, this one's interesting, TSN. We can see here that we've got an upwards channel, but the price is trading below the standard deviation minus 2. So it's in the minus 2% range. That's quite interesting, but we're below the 50-day moving average, so we wouldn't really want to be trading that at the moment. But we could keep an eye on it for when it does move up and breaks through confirmation to show us that it's a good time to get in on the trade around this level. Okay, we've got BLDR open here, and we can see we're on an upward trend. We've hit the +2 and bounced off it, coming all the way down, and it's trending now between around the -1 standard deviation level, finishing at about 1.3. So we could be looking here at a strike price below that, maybe around, oh sorry, that's a 0.3, maybe around the 1.3 strike around here would be a good level. Okay, this one here, not so great. It's a little bit too high. We want it a bit further down. This one also trending a little high. This one looks good. Huntsman, Hun. We can see we're bouncing around the -1, +1, hitting +2 there and straight down to -2 and recovering nicely. We've got confirmation over the 50-day moving average. We're not far from the 0 standard deviation level there. So we could set the strike around this level here, or around about where the 50-day moving average is, or maybe slightly below it. This one's much too high from our 0 point level. This one's not too bad, just above the 0. So we'd probably be looking, that's now at 10.85. We'll be looking around the 9.5 area if we can get it. This one here, TWNK, is a possible one to look out for in the future. We're hovering around the 50-day moving average. We'd like it to come up a little bit more with confirmation. Once it gets up to around the 0 point line, which at the moment would be 21.5, we'll be looking at around a 20.5 for our strike. And finally, let's look at CDEV. This one's quite interesting. It's just above the 0 standard deviation. We're also confirming coming above the 50-day moving average. So this is a good candidate, 8.17. So we'll be looking here, maybe the 7.5 or the 7 in this area here for the strike price. Now, for the actual strike price we select, we also need to look at the options chain in our broker's trading portal. But for now, you can see how to select a potential stock based on its price relative to standard deviation. We can also use the standard deviation indicator to give us some help when exiting a trade. One reason to end the trade early is if we see that the trade is going against us. Having the standard deviation indicator on the chart allows us to gauge how the stock is performing relative to its recent price action. Seeing that an underlying stock price is falling into a lower standard deviation area may mean we'll decide to close the trade early to avoid any loss or any further loss. So for example, using this chart, imagine we sold a put around here when we're at this strike level, just above the 0, and say we sold the put at the strike of 7.5, which is around there. Now, maybe watch it falling through, and we can keep an eye on it, and as it comes towards, and we can see it's a good fall downwards, as it comes towards our strike and towards this area here, we might see this as an indication of the time to get out of the trade and sell before we make a loss or too much of a loss. So, as option sellers, we're concerned about the risk of our puts getting assigned to us due to the price of the stock dropping below our strike price. If we can calculate the standard deviation of a stock's price, we can get a lot of help selecting a strike price that has a low chance of being reached. For example, if I decide to sell a put on the stock shown in this chart, if I sell the put at a strike of $15, as this is at the -1 standard deviation, the percentage chance of the price falling below that price is around 16%. That's the 2% plus the 14%. If, however, I select a strike price of only $10, then there's only a 2% chance of the price falling below that strike price. Okay, so the -2 standard deviation strike price sounds much better, right? Unfortunately not. Option premium pays more for greater risk. At very little risk, the premium will be negligible and therefore not worthwhile trading. At -1 standard deviation, the premium might be good, but the risk will also be higher. So it's a trade-off between the two. For our purposes, we look for a strike at least 1.3 standard deviations below where the current price is at, which is often a point of good risk to reward. So if the price is currently trading at the 0 standard deviation level at $20, a good price to look to set our strike at is -1.3 standard deviation, around $14. Similarly, if the stock is currently trading at -1 standard deviation, that's $15, we'll be looking at around -2.3 standard deviations, so around $8. We'd need to check the simple moving average lines and other indicators to make sure that all this works, and also that the premium we receive is worthwhile. But you can see how powerful the standard deviation indicator is for entering trades at the right price. I'll explain how to set up the indicator in TradingView, as it's the charting platform that I use. You can also access the Standard Deviation Channel indicator in TD Ameritrade's Think or Swim platform, Interactive Brokers' Trader Workstation platform, and also you'll find it on Tasty Trade now. It's recently added to their platform, which is great to see. Unfortunately, the indicator doesn't seem to be available right now on the Webull platform, but let me know in the comments if this has changed, and also let me know about this indicator's availability on other platforms if you use them. So here's TradingView. The free plan allows you to do pretty much everything you need for simple technical analysis. You'll be able to add simple moving average lines and the standard deviation channel indicator as part of the free plan, and you can add more stuff if you pay. To add the indicator to the chart, click on the Indicators button up here and search for Standard Deviation Channel. Okay, and the one you want is with Leo Jez next to it there. It's the one I made and it's totally free. It's perfect for our needs. It works straight out the box. No need to change any settings or anything. So just click on it, close that there, and you'll see it comes up with this colorful dotted channel. By default, it's set to 6 months if you're on the daily chart. As you can see here, length is 128. So that's equal to 6 months of trading days with no weekends and holidays and so on. That's the time frame I use for my stock analysis. You can also change that to suit your time frame of choice. Here you see different deviations, so best to keep them selected unless you want less lines. You can change colors here if you want, and that's about it. You can use that with all your charts. Hopefully that was helpful. This is the first trading instruction video I've put on YouTube, so please let me know if you want more in future down in the comments below. And also please like and subscribe to receive more option trading videos. If you enjoyed this video and want to see more option trading videos, head on over to our website at wheeloptiontraders.com. Here you'll find our Options Wheel Strategy Trading video course. We have over 50 videos and counting, from the basics of understanding and trading options through to using the wheel strategy to get the most out of your options trading. We also have an amazing options wheel strategy tool that you can download. It tracks all your trades in real time and provides key insights to help you with your options trading decisions.